Please join me in welcoming Mr. Dean Bernard.
All right. Thank you, Stephanie, and thanks for having me here today, guys. Sorry. Now, I'm really excited to talk to you about something that I've grown really passionate over the last couple years. Now, the strain and stress of everyday life is not easy for anyone, but when you try to do it with a disability, it becomes infinitely more demanding. So I'm here to talk a little bit about the elements of financial planning. Now, in every plan, there are 4 key elements that need to be covered before going ahead. And it doesn't matter whether you're young, old, whether you're rich or poor. More important than anything else is making sure these areas are in alignment. So first you have your short-term reserve, and that's simple enough. All that is really your rainy day money, savings set aside in case the tires on the car fall off or the water heater goes. Next you have your moderate term goals. So that's things like, it's different for everybody, but it's things like educating the kids with Rsps, saving up to buy a house, a cabin, maybe that dream vacation, maybe paying off some debt. We just want to make sure that those goals don't get neglected along the way. Next, you have your long-term goals. And what that is really just financial independence in retirement. And you're going to do that through a few different channels. First, you have Canada Pension Plan, you have Old Age Security, you have work pensions, you have personal RSPs, and something that's become a really, really valuable tool for retirement planning over the last few years are tax-free savings accounts. That's because the first 4 options, they all have one thing in common. They're all 100% taxable to you when you take them out. So if you need to take a little bit extra out one year, like let's say you have a rainy or a hole in your roof or something that needs to be repaired, that could potentially push you past the OAS clawback limit, and the government will start taking away your benefits the next year. So the tax-free savings account has become a great tool for preventing that. Now last, and probably most important, is protection. So that's protection in the form of life insurance, disability, critical illness, long-term care. And why I say it's the most important is because if you don't have the proper coverage in that area, it doesn't matter all the great work you did in the other 3 areas. If something happens, everything else is going to come crumbling down, and it can send your financial life into an absolute tailspin. And we've all seen it happen to someone, I'm sure. Now, the thing with planning is that the hardest part is just finally agreeing to sit down and do it. Once you get started, it doesn't take too long, but there are so many questions and so many unknowns that it's just so much easier to put something like that off. But I can tell you from personal experience that it's a lot better to tackle the little issues now while they're still little before they become big issues later. And a great place to start is by grabbing one of these roadmaps from the Saskatchewan Association for Community Living. They've got the basics on everything you need to know in regards to financial planning for people with disabilities, and the best part is they hand them out totally free. Now, most people have the right idea when it comes to saving for the future, but the way the world is, life gets in the way. So what the Government of Canada did was they set up this Rdsp program, and all it basically is a savings plan set up to help people with disabilities save for the future. Now, this can be a really amazing tool to help people, mostly because the government will actually dump in tens of thousands of dollars into it on your behalf that you can pull out at a later date. So there are some restrictions on it, so you have to remember that it's just one tool inside of a financial plan that's going to get you where you need to go. So some of the restrictions I was talking about are you do need to be eligible for the disability tax credit, which for someone with Parkinson's disease, they'd have no trouble getting approved for that. But you do need to be under the age of 60 to open up a plan. So it's not going to be available for everyone, but certainly for someone with early onset Parkinson's, this can be an amazing tool for helping them down the road. I'll talk a little bit about how this works. The bulk of the money you're going to get is in the form of the savings grant. So that's based on 2 things. It's based on the amount you put into the RDSP, and it's based on your family income. So if your income is less than $89,400, a $1,500 contribution from you would result in a $3,500 grant from the government. If it's over that amount, they're still going to match it $1,000 for $1,000 up to a total max of $70,000. And what's nice about this is they also do have a catch-up period where they'll actually back pay you grants. The savings bond is really good for people with a modest income. And what's nice about this is you actually don't need to put anything inside of your RDSP, and the government will put in $1,000 every single year until you hit the max. And just like the grant, it does have a payback option, or a catch-up option. So, I mean, I've seen people open up these RDSPs, and in their first year, the government has thrown nearly $20,000 into it. So it's really an effective tool. Now, this graph just illustrates kind of the growth, the tax-deferred growth that can be achieved through starting it early. Now, if you're putting $1,500 away into it every year just to get the maximum amounts of grants and bonds, you do that for 20 years. At the end of 20 years, you'll put away $30,000 into it, and assuming a 6% rate of return, that $30,000 will have turned into nearly $250,000. So starting this early, it can be amazingly beneficial for a person. Now, the RDSP is a long-term savings strategy, and that's due to one important element. It's called the 10-year rule. Basically, the government just reserves the right to pull back a portion or all of the grants and bonds that they have put in the last 10 years if you start taking the money out early. So if the grants and bonds have been in there for 10 years or more, it's fine, it's 100% yours. But if they've been in there less than 10 years and you start pulling a portion out, they could take back some of their money. Government isn't completely unreasonable, though. If you do have a diminished life expectancy, all you need is a note from your doctor, send in to them, saying that that's the case, and they'll generally waive this rule. Just a few extra features here, but probably the most important feature to the RDSP is that the withdrawals that coming out of it aren't going to affect your benefits later on. So things like OAS, things like GST, or the SED program won't have any effect on it, or won't affect them at all. And we'll talk about that next. So for people who aren't familiar with the Saskatchewan Assured Income for people with disabilities, or the SED program, it's basically designed to provide financial assistance to people in Saskatchewan living with severe disabilities. But your income and assets do need to be below a certain level to qualify. So making sure the work that you do now doesn't affect your benefits now and down the road is a top priority. And I'll give you a real-life example of something that happened last year. My client referred me to one of his friends. And this guy had been in a pretty bad car accident. He was completely paralyzed. And because he couldn't work anymore, he had been on the SED program ever since. Now, he was living in a home. They were taking care of him. The SED program was paying for his expenses. But he finally got his settlement in from SGI. And the settlement was for $240,000. Now, the SED program has a rule that if you get a settlement over $10,000, they cut you off. And that's what they did to him. So he came to me wondering what he should do, and I told him he basically had two options. He could either spend all of his money he got from SGI over the course of the next few years till it was all gone, then reapply for SED, or we could start doing a bit of planning and look at his options. And what we ended up doing was moving $200,000 into his RDSP, which is the lifetime contribution limit. We put $15,000 into each one of his kids' RESPs, and he had $10,000 left over that SED allowed him to keep. So 6 months after we had kind of moved his assets around, he was allowed to reapply for SED. He's back on it now, but now he has $200,000 in his RDSP that he can take out anytime he wants in case there's an emergency or whatever the case. I mean, he called me a couple months ago because they were going to Disneyland, so they're good for whatever you really need them for. Now, when it comes to estate planning, leaving assets to someone with a disability can get pretty sticky as well. You basically have three different options. First, you can leave the assets to a third party, hoping they're going to do the right thing. But we're not living in a perfect world, unfortunately, so although most of the time this is going to be fine, there's really nothing enforceable or forcing them to make sure that they follow through on your wishes. Second option would be to leave them directly to the person with a disability. But every disability is different. Not every person is going to be legally capable of handling their finances. And if they are, but they're on a program like SED, the government's going to take away their benefits as soon as they get that money. So generally, we try to avoid that option. Third option would be to leave the assets to them indirectly through what's called a discretionary Henson trust. And I'll talk a bit about that more in a minute, but basically all that is a clause in your will. So let's assume, you can't really see it there, but I'm talking about my friend Leon. Let's assume Leon has a severe disability, his parents die, leave him $1 million in insurance policies or assets, and that $1 million is going to get him a 4% rate of return, which will draw him $40,000 per year in income. We're also going to assume that he has a part-time job where he makes $11,000 a year, but he enjoys doing that and he doesn't want to quit. So now we're going to look at his life, if that money is structured inside of a trust or if there's no plan involved. Now, if there's no plan, the money gets all smashed together and it gets taxed together and it gets taxed at a higher rate, leaving him with just under $41,000 in his pocket. If it's inside of a plan, it gets taxed separately because a trust is taxed as a separate entity. So the first $11,000 he makes isn't taxed at all. The next $40,000 is taxed at 17%, and that's going to give him an annual tax savings of $3,300 every single year, all because mom and dad took a few extra minutes to do some proper planning. A couple other reasons why we do this. First is marital protection. And it's not that you don't love your sons and daughters-in-laws, but you kind of want some control in where your inheritance is going. So let's say Leon's married and his parents die, leave him all this money. A few months later, his wife says, "You know what, Leon? Turns out I like your best friend better. I want a divorce." It happens, right? You can bet they're going to try to get half, because why wouldn't they, really? They're entitled to it. So that money's gone. But if it's structured inside of a trust, it is 100% protected, because in the eyes of the courts, it's not Leon's money or his spouse's. That money belongs to the trust. Creditor protection is another really important reason why we do this. And I'm not just talking about creditor protection like you own a business and you have creditors, although that could be a reason. It can be for something as simple as somebody's walking by your house, they slip on some snow that should have been removed, and sue you for $2 million. First $1 million is going to come out of the house insurance. Where's the next $1 million going to come out of? That money's gone. Whereas again, if it's inside of a trust, it's 100% protected because it doesn't belong to Leon, it belongs to his trust. Now, before I wrap up here, I just want to talk a little bit about kind of the risks that people face in retirement and people who are leading up to retirement. So the number one risk, financial risk anyway, is simply running out of money. And it happens for a lot of different reasons. Maybe you're spending too much or you're not saving enough. Maybe there's an emergency or a disability that requires you to draw more out of your savings than you had planned. It happens. But one more thing that we're finding is happening more and more often is that people don't have the proper investment mix inside their retirement portfolios to accomplish the goals. Now, ever since the economic and financial chaos of 2008, we found that people have just ran for the hills, and it's still in the back of people's minds. I mean, you guys probably all remember seeing a big hit in your pensions that year. But what we found is that people who need a retirement income to last over 3 decades have kind of squirreled their money away into things like GICs, money market bonds, or money market funds, government bonds, and everything else you can think of that they perceive of as safe, which have absolutely no return net of inflation and taxes. Not that they ever did, but especially don't at these interest rates, the ones we're seeing today. So the problem is that we become fixated on the wrong type of risk. We as a people, we're about 100 times more worried than we need to be about risk of principal. And in the same breath, I'll tell you we're about 100 times less worried than we should be about the erosion of our purchasing power from inflation. Now, this gray line at the bottom there, that's inflation. This is an index chart. It tracks $1,000 from 1934 till now. The bottom's inflation. That's the cost of all the things you need to buy to take care of yourself going up. The top two there, or top three, are basically the US and Canadian markets. Now, we're taught when we retire that we need to get conservative. We can't see that volatility in our investments. We need to buy GICs, bonds, things like that. And I mean, I can see why. I mean, with the ups and downs and the spikes there, your money, that's your money going up and down and all around. Who wants to own that, right? But the problem is, if you go and you're investing in things like treasury bills and GICs and bonds, and you're barely keeping above inflation, once you get taxed on that money, you're below that inflation line. And once you're below that inflation line, you're losing your money. But let's just back it up a minute here. So long-term inflation rate in Canada, probably about 3%. So let's look at a husband and a wife who retire at 60. They're going to have a joint life expectancy of 30 years. Not that he's going to live to be 90 or that she will, but together one of them should. So at a 3% inflation rate, what's it going to cost in the 30th year to buy what $1 bought in the first year? Answer is about $2.50, $2.40. So what that means is if you don't have some type of mechanism in your plan to ensure that your income in retirement is increasing at a similar rate to what your cost of living is increasing, you're going to run out of money. And I mean, after all, during our working years, we rely on that employer to give us that annual 2-3% pay raise to keep up with inflation. But once you're retired, the onus falls completely on you to give yourself that raise, so to speak. And just to kind of frame it, somebody just yell out how much you paid for your very first house. Anybody, just yell it out. 19,000? 10? I'm jealous. Now think about how much you paid for your last car. Probably more, right? Or the same? It's pretty scary when you think about it. But when it comes to your own retirement, really the only question that matters is, are you going to outlive your money, or is your money going to outlive you? And if you're not sure, then I'd be happy to help and see if we can figure it out together. Thank you.